Give me a specific example recently of some trading challenges that you've been through.
Oh gosh. Well, we're very lucky because we have a few traders that are extremely good at what they do. And they're able to be very entrepreneurial. And I do think that in precious metals in general, because it's such a small market, and because everybody knows everybody, you have to be entrepreneurial. You have to be able to pick up the phone and call 5 to 10 people to help you get whatever job you need done. So thankfully,
this is a very relationship-driven business.
Extremely so. So we haven't, the struggles are being there for the client and trying to talk them through the day-to-day of how much these swings can be. Because the spot price moves on its own fundamentals and its own drivers versus the lease rate. And many clients sometimes don't understand that the two don't have to be correlated. And the two necessarily are not correlated. So spot price could be going through the roof, 3% up on the day, and the lease rate is steady, or vice versa. So trying to have those discussions with clients has been the most challenging part. And one of the questions that they'll ask is, well, when will the lease rate come down again? And the fact is, you're looking at two unknowns. You're looking at the cost of borrowing dollars and you're looking at the cost of borrowing metal. And each has its completely own different set of drivers. And so it's like looking at two crystal balls and not making the numbers come to term.
Yeah, and what's interesting is you just mentioned a few moments ago that when the market is in contango, that's an advantage for the bullion banks and their customers because it acts as basically a discount to a standard interest rate. But what happens is that the market can also go into backwardation where the front month contract is higher than the future contracts. And then the reverse is true, that actually the lease rates can exceed what would be like a standard line of credit. And those swings can happen in the span of a few days. So you're a major company in the bullion space and you're sitting on, say, $50 million worth of inventory and an attractive lease rate. And then 3 days later, that same inventory is now working against you. And it puts you in a position where you might have to liquidate a large, percentage of your holdings at any given time. The backwardation aspect of this is, correct me if I'm wrong, but this happens because the banks are concerned about tariffs in the future. So they're pulling forward demand on the physical side into the front month, which raises the price of the front month contract. Is that right?
Yeah, so they're just changing the shape of the curve by trying to pull in metal earlier. So they're worried about short-term supply. And when they do that, yes, it bumps up the futures month more so than the back end of the month. And that's what we try to tell clients oftentimes is when you're looking at considering financing in dollars versus financing in metals, you can't look at it on a short-term basis because short-term, 9 out of 10 times, it will look great. But 1 out of 10 times, it will look terrible. And it just depends where you get in and where you get out. So you really have to look at it over a long-term period of time because commodities is cyclical and you do have to have that lens on in order to make sure that it's still net positive for you when you compare it versus your weighted average capital cost.
Are you always trying to keep a sort of a neutral exposure to the market, or are you taking long and short positions on behalf of the bank?
So we are usually holding inventory depending on what we think our clients will need at any given time. And our positions are driven by that. So it just depends, if we have clients in the US and we think that they're going to need high purity silver, we're going to have more of that. If we have clients in Europe and we think that they're going to need sponge, platinum, palladium, we hold more of that. So all of our trading is driven around having inventory available for our client needs.
But that inventory is on your balance sheet, but that doesn't necessarily mean that you're taking full exposure
Correct.
to the price movement.
Correct.
So are you trying to keep your price exposure at par, basically taking note? Let's say it's silver and you have $10 billion worth of silver on the balance sheet. Are you taking 10 billion in short positions on the other side to price out the risk, or are you taking long positions or short positions in the market? How does that work?
We typically look at spreads, whether it's month-to-month spreads or whether it's location spreads, that we will look at those fundamental deviations. But we do have really tough risk parameters in terms of what we are able to take risk on and what we're not able to. So whatever we are able to put on is usually driven by market risk, by liquidity, by availability to financing and inventory, by exchange limits, et cetera. So typically we will hedge most of our positions, and then we'll trade around that as needed.
Okay, I recently saw on X some data that stated that the banks are net short 50% open interest in silver. We already know that we have a structural deficit in silver. What does that mean, and how should people look at that as it relates to price? I mean, silver has skyrocketed; it's up, another 15% in the last couple of weeks, and yet the banks are 50% net short open interest. How is that to be interpreted?
I think that ultimately you have to look at it as a combination of your futures positions and your OTC/physical positions. So just because a bank may or may not be short on the futures doesn't mean that they're short across the board. It typically means that they're long on the physical end of it. And the reality is, like you said, it's in a deficit because there is demand there. Mm-hmm. So we're constantly long that physical because our consumers want that.